Did you know that the US has more than 4,000 companies listed on its stock market? Taking that into consideration, why should you look to invest in a market outside of the US? The answer is simple. It is because you need to 1. Reduce risk, diversify, and 3. Increase profits. Hello everyone and welcome to NOVARISE, your channel for financial education. According to a study by Nationwide Financial, the percentage that you should allocate to foreign investments is 40% of your portfolio. However, US investors allocate approximately 20% of their budget to markets in other countries. The US economy has many people worried. With an increasingly volatile environment, it wouldn't be a bad idea to look for ways to protect your money by investing in markets outside of the US. You see, there are international options that are just as or even more profitable and stable than those in the US. In today's video, we will talk about investment opportunities in markets abroad, as well as how you can invest in international shares. So let's get started. As mentioned in NOVARISE, having a diversified portfolio is one of the best ways to protect yourself financially. But whenever we talk about diversification, we usually refer to investing in different local markets, such as real estate, stocks, crypto, precious metals, or commodities. And this is because when you spread your investments across different markets, you lessen your risk of losing money. And if you decide to invest in international opportunities, then you could diversify and possibly reduce your risk even more. Now, there are a couple of benefits to investing outside of the United States, and these are risk and return patterns. Veronica Willis, Wells Fargo's Investment Institute analyst, says that stocks and bonds have different risk and returns depending on the country they belong to. And this is a big positive in case the US economy continues to fall. When we invest in American companies, they're all under the same economic wavelength. And that's why buying shares in other countries can be a good investment strategy. And if you don't know how to do it, don't worry. We will later go over the markets you could explore. But for now, let's just continue with the next point. Possible geopolitical advantages. You see, government measures often allows some companies to grow faster than others. The same happens with the geographical locations, which provides an advantage for certain markets. Each country has unique conditions that can directly impact investments. Your ability to learn and understand what's impacting those economies could give your investments a competitive advantage. In fact, the CEO of Think Markets, an international investment firm in Australia and the United Kingdom, comments that international companies could represent a relatively more attractive market value compared to their US peers. Diversifying beyond US index funds. Yes, the US has a very powerful economy, and there's no doubt about that. The US stock market has been posting rising returns of approximately 320% from March 2009 to 2021. But that hasn't been the case lately due to recent declines in the stock market. When we talk about international investments, many people may think of domestic index funds, but the truth is that this form of investment only gives you partial exposure to international stocks. Now, you might wonder, why are they called domestic index funds then? Well, they're called domestic index funds because they invest primarily in US stocks and domestic funds. Louis Strohmeyer, Octavia Wealth Advisor, partner and advisor, says that if an investor wants real exposure to international stocks, it is better to invest in international funds and indexes directly. And all this leads us to the question of how can you invest internationally? Well, it's easier than you think. There are many options in which you can put your money abroad, and some of these are shares in international stock markets. You can buy shares in international markets through multiple online platforms enabled to operate in the US or in different countries. You can also open an account with a brokerage company and make international investments as long as the security is listed with the brokerage house. And the best part of this is that you can invest with US dollars without the need to convert to other currencies. And for your reference, some of the most popular brokers in the United States are Fidelity, Charles Schwab, and Interactive Brokers. Another option to invest internationally is by opening an account with a brokerage in the country where you want to buy shares. For example, Monexboom, a platform based in Hong Kong, allows you to buy shares on the Hong Kong Stock Exchange. Monexboom also allows you to participate in trades with over 11 other markets. American Depository Receipts, also known as ADR. ADRs are certificates issued by U.S. financial institutions that manage shares of foreign companies, and they trade just as you will with domestic shares. And the best thing about ADRs is that you won't need a special brokerage account to access the international market. ETFs or mutual funds. Through your brokerage account, you'll also be able to invest in exchange-traded funds, commonly known as ETFs. Through these investments, it is much easier to diversify your portfolio with international markets since you won't have to select specific stocks. They generally have low cost and they're usually easy to trade on your brokerage account. Multinational corporations. If you don't fully trust the international markets or prefer to start investing with a slight international exposure, you could do so with international companies such as Coca-Cola or McDonald's, which are companies that depend largely on their international operations. Real estate offers you the benefit of receiving extra income from a different market. An example of this is an Airbnb property located in an area with high tourist traffic. Aside from the extra income, you'll also enjoy the benefit of being able to stay there whenever you like. Countries like France, Mexico, Spain, and Italy are usually excellent options to invest in real estate outside US borders. Now, if I were in your shoes, I will probably be asking, how much should I invest internationally? Well, Vanguard recommends that 20% of your overall portfolio budget should be allocated to international stocks and bonds. And if you want to go even further with internationalization, Vanguard recommends allocating 40% of your stock budget to international stocks and 30% of your bond budget to be allocated to international funds. Now, I know this is relatively new. We don't usually talk about international investments and stuff like that. So I would love to read your comments. Do you find this type of information interesting? Let me know down in the comment box below. And if you happen to know of someone, feel free to share the love and then just send this episode their way. And while you're still here, don't forget to hit the like button right here at the bottom. Now, let's continue. Types of international markets. When we think of international investments, there are two types of markets. Developed markets, which are located in countries with stable industries, multinational companies, stable economies, democratic governments, developed infrastructure, and a relatively high standard of living. An example of these markets are the United Kingdom, France, Canada, Australia, and Japan. On the other hand, we have the emerging market, which belongs to countries with developing capital, relatively stable economies, financial policies with great international openness, and growing societies. Examples of these markets are India, Mexico, China, South Africa, and Egypt. In addition to stocks, you can also invest in international funds that participate in multiple markets within specific areas. These funds usually divide their investments into regions, such as Asia Pacific, investing in areas like Australia, Japan, Hong Kong, and Singapore; Europe, giving priority to the United Kingdom, France, Spain, and Germany; and Latin America, with emerging markets such as Brazil, Mexico, Colombia, and Chile. Now, what are the risks of investing internationally? Well, just like with any investment, investing internationally also involves risk. And before proceeding with any investment, you have to analyze and study the market in which you plan to invest. Additionally, you should also take into account the following: currency fluctuations. Remember that when investing in another country, another type of currency will come into play. And while this can be seen as a benefit, since in most cases the US dollar benefits compared to other currencies, you should still be prepared for unfavorable results. Political instability. Political stability directly impacts the value of shares. You see, when you invest in a company overseas, you're also investing in the local economy and its people. Political instability is usually present in emerging markets. However, the term political instability is relative, even in countries like the United States, which has seen its own share of political instability in recent years. Regulatory changes. International markets have their own rules and regulations, and you should always research or consult with your broker before making any investment overseas, as you can face limitations due to the fact that you are with a foreign status. Taxation. You must take taxes into account when making international investments. Your accountant will be your best ally to keep you on the good side with the IRS. We know that international investments can be challenging, especially at the beginning of your journey as an international investor. Despite all this, it is possible to benefit from this type of investment when making an informed decision based on knowledge provided by investment professionals or by educating yourselves with channels such as NOVARISE. And while I still have you here, feel free to check out this episode right here, which will complement everything you just learned today. And I'll see you soon. Take care. Bye-bye.